Part 1. It's all about timing. Meet Spencer and Angeline, co-founders of VanCat, a thriving catering business in Vancouver. Last year, VanCat had a great run. They earned $480,000 in revenue. Their expenses totaled $360,000, leaving a $120,000 profit. On paper. But here's the twist. They weren't swimming in cash. Why? Because in finance, there's a difference between the accrual concept, which records revenue when it's earned and expenses when they're incurred, and the cash concept, which only counts actual money in and out. Let's break it down. Revenue timing. About 60% of VanCat's clients pay on 60-day terms. This means that 60% of the revenue, or $288,000, and therefore 60-day terms, or 2 months out of 12, 1/6 of this amount hasn't been paid yet, $48,000. That revenue has been earned, but the cash isn't there yet. Now, expense timing. Meanwhile, VanCat's expenses are immediate. They totaled $360,000, which included $180,000 for salaries and contractors, $60,000 for kitchen rent and utilities, $96,000 for ingredients and disposables, and $24,000 for insurance, tech, and administrative expenses. For simplicity's sake, we assume that all of these expenses were paid before or right after each event. However, in December, Angeline and Spencer also decided to replenish their inventory and several crates of vintage wine, disposables, and various dry goods. The total bill came to $20,000. So let's bring it together. Their revenues were $480,000, but $48,000 hasn't been paid yet. Their expenses were $360,000, paid throughout the year. An additional inventory purchase was made of $20,000. Therefore, their cash flows are their revenues minus their outstanding cash of $432,000, their expenses of $360,000, and the additional $20,000 inventory purchase, which means they have only earned $52,000 in cash versus a paper profit of $120,000. In business, it's not just about how much you earn or spend, it's about when that money moves. Revenue might be earned today, but paid a month later. Expenses might be incurred now, but paid next week. That's why timing matters. It explains why a profitable company like VanCat might still struggle with cash flow. And understanding this difference is the first step toward making smarter business decisions.